Folks, we need to talk about AI, artificial intelligence, already cutting jobs. We can talk about buying Vegas, housing crash that is only getting worse. We got to talk about some warnings about core services around inflation. And we're going to give you some updates on what CFOs and mortgage apps are saying. But 1 second, I forgot to plug something in. 1 sec. Please like, subscribe, comment, become part of the family here at One Rental at a Time. I would appreciate it very, very much. So folks, let's get into it. IBM CEO in their last earnings call talked about artificial intelligence coming in and basically wreaking havoc on the employee base. And sure enough, folks, it has started. IBM is cutting jobs in marketing and communications. Folks, this is likely coming if you are in a big behemoth like IBM and you are in a role that is very focused on writing or the creation of, you need to become very indispensable. And if, such as learning AI and AI tools would go a long way towards protecting your job. So again, IBM said it was coming. It is now happening. And we're likely talking about thousands of roles. Again, I am not one of these people that thinks that AI will replace everything. I am old enough to remember when the internet was supposed to replace everything or the computer was supposed to replace everything. But that said, jobs will change. You will need to become a prompt engineer or whatever it is. So again, invest in yourself, look for the opportunity, and as always, get close to revenue. The closer you are to revenue, the more protected you are. Next, I want to talk about buying Vegas. As you know by now, I am going to try to do the One Rental at a Time buy box in Las Vegas. I am looking for cash flow. I am not looking for appreciation. I'm not looking for break even. I'm not looking for any of that noise. So if you want to be a part of the series Buying Vegas, and you are in Las Vegas, or you have friends in Vegas, or you're part of the Sub-2 community, or any other community, if you find an opportunity in Las Vegas that you think will cash flow with a reasonable down payment, please reach out to me. I'd love to start collecting leads in deal flow. And if you'd like, you can be a part of the series and on the channel if that is of interest to you. Again, I'm looking to prove that you can do the work, you can network, you can grow, you can find opportunity. So again, if you are in and around Las Vegas, or if you have an opportunity, please let me know. I would specifically be interested today in perhaps seller financing. Perhaps there's a landlord that's frustrated, that wants out, that wants a certainty that the payments will come. I am certain that I could be that person for you. So again, don't know where this will go, but if you are in Las Vegas and find a deal that you think will cash flow, reach out to me, let me know. We can have a conversation. So let's talk about the housing crash that is clearly not over and frankly, clearly getting worse. This is, of course, happening in China. Yes, folks, it seems like 3, quite possibly 4 years ago, we were talking about Evergrande. That saga disaster unfolded. Then it went to, I think it was Town and Country. That disaster has unfolded. Now we are to Vanke, I think it is. Where is it? Yep, Vanke, V-A-N-K-E. This is a government-sponsored or government-backed developer that is now having challenges paying back their debt. They are trying to do extend and pretend. Folks, the housing market in China might be, to use a baseball analogy, in the 4th or 5th inning. And of course, if you don't know baseball, there are typically 9 innings. So they are in the middle of it. They are in the chaos. This is going to get worse before it gets better. I think what is happening in China when it is all unfolded could be one of the largest disasters in the housing market when you look nationally. It was propped up by years of bad lending and bad assumptions, and now that is coming home to roost. Let's talk about core services. Folks, I really do think that what we saw yesterday in the CPI reading, again, remember CPI headline went up. It was 3.1, now 3.2. It has broken the downward trend. I think if you look even deeper inside the numbers, which I did after yesterday's recording, there's a concerning reality that I think we just need to acknowledge. What has really led to the drop in inflation? Well, it has been goods, right? We've talked about that being the easy stuff. And we have seen a lot of energy deflation, right? That has allowed us to go from what was a 9 or 9.1 CPI headline to as low as 3.1. But we are in the hard part. And again, as we have talked about many times on this channel, the U.S. economy, as it sits today, is dominated by services, not goods. Why is that important? Well, we are probably going to be yanked around by services inflation. And again, the largest parts of services is us, it's people, it's wages. So, when you uncover or go deeper on CPI, you look at what's called CPI services, X energy. You could think of that as CPI services core. That's what you could think of it as. What you find is an alarming fact. CPI services core, again, X energy, when you do it on a 6-month run rate, is actually at 5.8%. Let that sit there for a minute. Now, of course, it should be stated that we also know that shelter inflation, which is in that calculation, is distorted. Owner's equivalent rent shelter, 33% of CPI, is grossly overstated. I think we all know that. But there is a trend that bears watching. And again, as an economy that is largely driven by services, and services are largely driven by wages, we need to start paying attention to this. And this is, again, one of the possible reasons that we see no rate cuts in 2024. No rate cuts. At this point, I stand by what I shared earlier in the week. I believe there will be no cut in March, no cut in May, no cut in June. As of right now, this morning, I believe the earliest we could see a 1/4 point rate cut is July. The next opportunity for a scheduled rate cut would be September. I honestly see the Fed doing nothing in September. It is too close to the election. Powell wants nothing to do with being told that he's helping or hurting so-and-so. He doesn't care. Neither candidate running for election likes Powell. Both candidates want to replace Powell. Powell wants to be done. He is playing a different game, and let's not forget, he is already rich. If you gave Jerome Powell true serum, I believe he would flip off both people and say, I don't care. So, we'll see. We shall see. So, again, the first chance is January. Where'd January come from? July. If inflation is still a problem, if CPI headline is still 2.8 or whatever, if core is still up, if PCE is still up, and July goes by, the next opportunity, in my opinion, for a rate cut is December, post-election. We could be higher for longer. And if you look at what's going on in the stock market, what's going on with Bitcoin, frankly, what is going on in housing, does anybody really think we need a rate cut? I mean, seriously, really? Does it feel like it's slowing down to you? That said, there are some underlying things in the employment report that we tore apart last week The employment report with their 275 creation was a total travesty, complete garbage. It did not stand the weight of inspection. But let's see. Let's see. We've got a lot of data points between today and July. It's all about July. The job market, to put it in context, I think the last unemployment reading was 3.9. I suspect in order for a July rate cut to happen, we would probably have to have the unemployment rate at least at 4.2, possibly 4.3. If we get an unemployment rate of 4.5, you can count on a rate cut. I'm just trying to give you the guardrails to see what's coming. These are not calls, these are guardrails. So again, lots of data between today and July, plenty of inflation readings, plenty of job markets, plenty of weekly claims, all of those things. So again, no rate cut in March, no rate cut in May, no rate cut in June. It is all about July at this point. And again, if it is July, let's be clear, it'll be a quarter point. It will be a quarter point. So again, we are talking July or December. Wanted to give you some updates. It looks like mortgage applications are up. Again, folks, I keep telling you, rates matter. Below 7, consumers think good. Above 7, consumers think bad. This is just where we are. It just is where we are. You can argue it, you can hate it, you could call me an idiot, whatever you want, but the data is the data. You can't argue data or data. Is it data or data? I have no idea. At the end of the day, we've seen 2 weeks in a row with rates below 7. Last week, mortgage apps were up 12% week on week. Today, they are up 5% week on week. So again, up 12, up 5 week on week. So very interesting. Lastly, we can talk about CFOs, Chief Financial Officers. CNBC has done a survey of 100 Chief Financial Officers at public companies. What are they saying? They are saying that they believe that inflation will be above 2% until 2025. Something we're going to get at the next Fed meeting next week is we're going to get the SOPs. We're going to get basically the dot plot. It'll be very interesting to see where the Fed presidents put inflation going forward. 48%, let's call it half. Half of CFOs think a soft landing is going to occur. Interesting. 15% think it will occur in the second half of 2024. Second half of 2024. 7.5%, which I'm not sure how you get 7.5 when you interview 100. Somebody messed up math. Where's the half come from? Anyways, half of the folks think it will be, 7.5 think it will occur in the first half of 2025. And then finally, 15% think the recession already happened. Why are CFOs important? Well, chief financial officers are essentially capital allocators. That's what I want you to think. Capital allocators. Capital allocators are making choices about capital investments. And if CFOs think a soft landing is possible, they will be making capital allocations. If they think a recession is coming, they will not allocate. So this is important to watch. So again, folks, I hope you have an amazing day. If you are in Vegas or buying in Vegas or know people in Vegas, I would love to hear about opportunities. But of course, let's congratulate Francisco. Francisco, congratulations on getting your ADU. Congratulations on getting your ADU. Derek, that ADU guy, will be impressed, and thank you. Folks, Francisco, congratulations. Again, remember, if you're ready to start doing the work, I have an amazing course, How to Get Started One Rental at a Time, at only $399. And if you buy it, I will give you the Las Vegas event, which is $199, call it $200 value. Join the group, join the Facebook community. It's the worth price of the admission. Get around all of these amazing people, network, ask questions, introduce yourself. Folks, take care. Oh, we got Paul. Hey, Paul, how are you? Thanks for the super chat, Paul. I appreciate it. And you know what? I got one more topic just for fun. Got this from Chester again and Resi Club. Realtor.com. The 5 hottest and the 5 coldest markets. Again, folks, this comes from Resi Club. It is actually a long list, but I just chose the top 5 and the bottom 5. Let's go to the coldest first. Bend, Oregon. Bend, Oregon. Lafayette, Louisiana. Panama City, Florida. Lake Charles, Louisiana. And I have no idea how to say this one, so I'm going to guess it's Huma, Louisiana. So it looks like the coldest markets are in Louisiana with one in Florida and Oregon. What about the hot? We've got Columbus, Ohio. Springfield, Massachusetts. Worcester, Connecticut. Rochester, New York. And finally, Manchester. Shout out the Lumberjack. Looks like Manchester, New Hampshire is the hottest market, which he keeps telling us about. All right, folks, take care. Have an amazing day. Again, thank you for the super chat. 21 thumbs up. 97 folks watching. You're amazing. Thank you for being here live 7:30 each day with me. Take care. Be blessed. Bye.